So today's topic is the Affordable Care Act, and it is commonly known as Obamacare. I will tell you that David Smith, who is our speaker, he is the Vice President of eBen Concepts, which is a consulting and employee benefits agency out of Fayetteville. He has an incredible background and a lot of experience. I will give you the quick highlights that he is a graduate of UNC at Chapel Hill. I see you frowning. He has a law degree, and he has worked in various capacities with Blue Cross and Blue Shield. He's practiced law. He serves on a variety of committees and agencies dealing with all of this. So he has a great background to share this information with you. His full bio is on your table if you're interested in knowing the details. He's saying it's not interesting, it's not true, but without further ado, I'd like to welcome David Smith, speaker.
Even though I was told I really couldn't do this without a mic, can you still hear me all right? Even back there in the back? All right, good. Because I really hate a mic. I don't know why. Can you think I'm all right on there? Yeah. All right, I'll try and use it. Guilt. And in the spirit of cooperation, I do have Terry Gutierrez here, who's also with the Legacy. They're actually a competitor of ours, but I think Terry and I have known each other for a long time, and so I thought it would be a good chance for her also to share some of this presentation with you. We have a copy of the presentation that we'll be glad to get to y'all afterwards, and it's kind of longer than this, but really going to focus on a handful of things affecting people beginning next year. This presentation is kind of version 45, and literally today I kind of made final changes to it. Why is it version 45? Because we started with a piece of legislation that was about 600 pages. It was passed on March 23rd of 2010. Since we've had somewhere close to about 300,000 pages of regulations, clarifications. In fact, this picture here is from one of the senator's offices in Washington, who actually stacked every bit of regulation that's been issued on this bill since it started until about 2 weeks ago in their office. Now, all that being said, this is not a partisan discussion. I think the mistake that people make in this, talking about this, is to talk about it from a political perspective. The politics are irrelevant now. This is the bill that's going into effect in less than 9 months. People need to know what's going on with it, so we're really going to focus on that aspect of it. I did say this, well, I didn't really say this, but I'll say it again. If you have questions as we go through this, ask them. There are no stupid questions. And so we'll be glad to answer them. If you're shy, which I don't understand why anybody would be shy, but if you're shy, we can stick around for a few minutes afterwards and answer them for you as well. So I'm going to start with kind of one of the basics, which is the individual mandate. Why do we have the individual mandate? Because today about 12.5 cents of every dollar of premium paid by fully insured plans is paying for the uninsured. Anybody who goes to the hospital, here, Winston, wherever, and they don't have health insurance, their expenses are paid by you. Because when you or one of your employees goes to the hospital and has something done, if it costs, say, $3,000 for that surgery or outpatient procedure to be done, they're going to charge you $4,500 because that extra $1,500 is actually reimbursing those people who came to the hospital and didn't have health insurance. And so if everybody in America has health insurance, it actually has a positive overall effect on the cost of health care. And so everybody in America, beginning 1/1 of next year, we require to have health insurance. Now there are some exceptions to that, but I don't really think about them as being exceptions because some of them, like no income tax liability, income below 100% of the federal poverty level, they'll both be in Medicaid. So they'll have coverage. People who are members of Indian tribes, well, they have the Indian Health Service. They can get coverage through that. Incarcerated individuals is actually an interesting way to get coverage. You don't pay the penalty, you go to jail, you actually get coverage that way. Individuals not lawfully present sounds like a Star Trek episode, but in reality it's just that they don't live in the United States. And then the top category, religious objectors, there's one case really still pending on that. Most of the courts have decided that if you're a follower of the broad Christian tradition, you don't really have an out. So I do know that there are some groups looking for a deity to worship to allow them to not have to have health insurance. So, any of you want to volunteer to play the role of that deity, please let me know. They're actively looking for someone to worship. Now, in a serious way, what does being covered means? It means you got Medicare, Medicaid, group coverage, individual coverage. You work for the state or the feds, and you're covered under their plan. And so when you look at all of this, it just means you've got coverage for 12 months. The only exception to that is if you're between jobs and you're without coverage for less than 3 months. So as a general rule, the deal is everybody has coverage for 12 months. I'm going to skip that because it's too confusing. So, what happens if you don't have coverage? The first year, not having coverage means you pay a penalty of $95 per adult, $47.50 per child, up to a family cap of $285, or 1% of income, whichever's greater. So a whole bunch of people say, hey, well, I don't have to have health insurance, it costs me $95. And I make $22,000 a year, so whatever. All right, well, that means what you'll pay is $225, not $95. And the next year it goes up to $325, $162.50 max on the family of $975, or 2% of family income. And then the final year it goes to $695 per adult, $37.50 per child with a family cap of $2,085, or 2.5% of your family income, whichever is greater. And so the point is that there is a penalty. It's kind of slowly ramping up, but these levels of these penalties really at the end of the day work out to be not enough, frankly, in my opinion. And interestingly, the biggest proponents of increasing these penalties nationally are the health insurance companies, who, by the way, are also the people who are really behind this bill nationally. Because if you think about it, if there is no public option in this plan, so you can't really go be on Medicaid if you don't qualify for Medicaid. You've got to be on a private health insurance plan, and so they're getting a bunch of customers. And they really want this penalty to go up. Today in Massachusetts, the penalty for not having coverage is about $100 a month. And about the best cost product in the state of Massachusetts is about $150 a month. The uninsured rate in Massachusetts went from about 15.5% to 1.5%. And literally went to people and said, hey, you could do nothing and pay $100 a month, or you buy health insurance and you spend $150. Why are you doing that? And the answer was, I'd rather pay $150 and get something than pay $100 and not have anything. And so, the sociological guessing work in this is going to be actually interesting to watch and see how it gets played out.
How are they planning on collecting this?
Taxes. So it'll be part of your tax file. And so one of the things, now in Massachusetts today what happens is every employer, every plan that's issued in the state of Massachusetts, they issue to every person there something called a 1099-HC. And so on this 1099-HC, it indicates how many months you were covered during 2012. And so if you have a gap in there, you file your taxes and you have to pay a penalty for how many gap months you have in there. The way it's going to happen at least on the employer side, is this healthcare cost issue is going to show up on the W-2. But what we know is going to happen is there's going to be some additional reporting that's going to have to be given to God and everybody that says you had coverage from January to July, and then you changed jobs, and you got a new job, and you started coverage there the 1st of September, and did coverage till the end of December. And that way when you file your taxes, there's probably a little line in there saying how many months did you have health insurance, attach the forms, and then if you got a gap there, they'll make you pay a penalty. So, that's unfortunately, we don't know the answer to that question. We expect that to be kind of maybe about that much on the top of that stack when we finally get the answer to that. So what I'm going to do is shut up for a second and let Terry talk about really the exchanges and some of the rating changes that are happening. Because Terry, in addition, obviously she's been with Legacy for a little over a year now, but Terry's also served at the state level on a couple commissions that are really responsible for figuring out how this thing was going to be implemented in North Carolina. So she really is more of an expert on this than me. At least that's what I'm going to say to her right now. And I'm going to let her talk about that for a minute, and then I'll come back and talk about the employer mandate.
Okay, as we're talking about the marketplaces, as we're calling it now, it's not called exchanges anymore, and the reason we're not calling it an exchange anymore is because you can't translate the word exchange in Spanish into anything. So that's why it was changed to marketplace. So, for North Carolina, we were going down the road of participating in a partnership exchange. You could be a state-based exchange, you could be a federal partnership exchange where they were going to provide the IT infrastructure, we were going to provide the rest of the background information for it, or you could be part of the full federal exchange program. Well, Governor Perdue said that she was going to elect that partnership option just to give us a little more flexibility and then let the new governor make the final decision. The governor came in. Unfortunately, we had some senators that turned around and filed a bill called Senate Bill 4, which was the bill that said we were not going to participate in a partnership or a state-based exchange. We were going to go into a full federal exchange. So Senate Bill 4 has passed the House, passed the Senate, and it was signed by the governor. So we are now a full federal exchange, or that's what's going to be coming down the road for North Carolina. In the exchanges, there's going to be two different marketplaces. There's going to be a marketplace for the individual to purchase insurance. This we feel is going to be the most robust of the marketplaces. We actually have about 1.2 million uninsured North Carolinians out there that will be eligible to come into that marketplace. Some of them could have been eligible for Medicaid under the program if we had elected to participate in the Medicaid expansion, but we have elected to not participate in that. Right now, today, Medicaid covers your pregnant females, it covers disabled adults, it covers children under 6, and it covers children up to age 18 if the family makes less than 100% of the poverty level. Those are the only people that actually roll into Medicaid as of today, and that will continue for North Carolina. So we're going to leave this gap of coverage out there for a lot of citizens that probably will actually fall underneath that 100% of poverty level to qualify for the exchange and will be left without anything out there. But there is an individual marketplace for the individuals to purchase coverage. This is for employers that do not offer coverage. They can buy it. If you're self-employed, you can buy coverage through the marketplace, or you have inadequate or unaffordable coverage that's provided by the employer. If you meet one of those qualifications, then you're going to be placed in the marketplace. There are going to be premium levels that we call the metal levels that will be available out there for us. Platinum, gold, silver, and bronze, and then there's a catastrophic piece that's also available if you're under 30. And then we have the shop marketplace, and this is going to be for employers that want to purchase. Starting today, or starting in 2014, it's going to be for full-time, 50 or less employers to purchase. Our Health and Human Services did pull back a little bit on the requirements for this in the last couple weeks, where they said, we were going to make two different options available for you as an employer if you're going to purchase through the shop. The first one being you could come in and pick a particular plan, just like you do today, buying through the private marketplace. And we could also let you come in and pick a metal level. So you could pick a silver level plan, and you could let your employees go to that marketplace and pick any of the silver level plans that were out there. But they pulled back and said we're not going to have the technical capability to do that in 14, so we'll try and make that portion available in 15 for you. All right, the individual marketplace.
Wrong direction.
Wrong direction. Thank you. The main purpose of the marketplace, again, was to allow individuals and small employers to be able to shop for insurance. The idea was to make it simpler and easier for people to acquire insurance, to facilitate the sale of qualified plans, determine if your non-Medicaid eligible individuals can receive a premium credit. These are all the different things that are going to happen when you apply to that marketplace. Health and Human Services has put out the initial application for review. For a family of 4, it's a 21-page application to determine if you're eligible for benefits. That's before you even apply for benefits. We're hoping that's going to be shrunk down a little bit. Yeah, we hope. But That's yet to be determined. State-based or federal-based or combination, we kind of covered that. There are 18 states that are setting up their own exchange. The rest of them are doing a combination and or will be a full federal exchange. Exchanges will open up for business October 1st. The deadline for implementation of a plan through the exchange is going to be March 1st of 2014. So initially there's going to be a 6-month window of time for individuals to apply and small groups to apply for coverage. Now small groups will have a small exception in there that as their group renews, if they choose to participate in the shop exchange, they can then not necessarily come on through October through March. They'll jump on whenever they go into their renewal situation. Premium tax credit. Is that the one you wanted to talk about?
No, you went.
Okay. The health insurance marketplace will be determined if the individual satisfies the income and other requirements. They will receive a subsidy or a tax credit. The tax credit, they can't receive the tax credit if they're eligible for minimal essential coverage other than coverage in the individual marketplace. Government-sponsored programs, eligible employer-sponsored programs, grandfathered health plans, and certain other health plans are going to be excluded from that. The amount of the premium tax the individual is entitled to is going to be determined by the exchange itself. Individuals between 133% and 400% of the poverty level are going to be available. They're going to have some sort of a subsidy available to them. It's an amount that tails off pretty quickly once you get past the 250% of the poverty level out there. And it's not going to be nearly what people think it is. A lot of people you're going to find are going to come up and say, where am I getting my free health insurance? Well, it's not going to be free. The plan was designed to cover about, on average, 2/3 of the cost, depending on where you fall in that poverty scale. With the increases that we're going to see in the cost of coverage, you're going to have a lot of people that end up being very surprised that their 1/3 of the cost is probably more than they would have paid for it today. How the premium tax credit's going to work, as David was saying, it's going to be computed on your tax basis. It's going to be a credit that is available to you out there. It is going to be paid directly to the insurance carriers if somebody qualifies for a credit when they buy through the exchange. If the taxpayer's credit amount is greater than the amount of the taxpayer's advance, geez, you made this wording.
Which is, we know that if somebody new comes to work for you, and one of the things we're going to recommend to our clients is, they come to you, you're going to say, hey, if you're receiving a subsidy through the exchange, and this new job means you're going to make more money, and it could change your subsidy, go tell them that. Because y'all all know who these people are who will come to you and be mad at you, because then they go pay their taxes, and they got to pay that money back, and well, you didn't tell me now I'm making more money, I'm going to lose some of that subsidy. So we're going to actually say to our clients, tell them when you hire them, they could lose some of that subsidy because now they're making more money. Well, I mean, I was going to say on the taxes and fees side, really, where's a lot of this money coming from to pay for it? Some of its taxes are going up this year. Some of it is related to an annual premium tax that's getting added to health insurance costs. So right now it's estimated to raise over $100 billion in the coming 10 years. What that means is health insurance costs are going to go up 2% for everybody because of this premium tax. And so it's one of the reasons why we're talking to some of our groups over 50 to say, maybe we ought to think about doing some kind of partially self-funded. Because if you're paying $1 premium, for every $1 premium you got to pay 2 cents. But if you're partially self-funded, you only have to pay that 2 cents on your stop-loss insurance. So it'll save some money for some groups. And there's also a reinsurance fee that goes into effect next year that is, in my opinion, probably the biggest boondoggle here, because all this is doing is helping the carriers manage out their risk on the individual side. So what's happening? Go ahead.
It's going to be $63 the first year that it's implemented. And that's on every one of your participants within a plan. It doesn't make any difference. It's going to be a collective thing. It does only last for 3 years. It's going down the second year to $42 and then down the third year to $26. But it's out there and it's going to be handed to everybody, including the federal government.
Yeah.
Imagine the government's taxing the government and all carriers is what we're doing.
Right, and I mean, I've got a group of 225 down in Goldsboro. They're going to pay $16,000 next year for this. And so it's one of the areas that we're watching. There's at least some discussion in Washington about revisiting this. The other thing that's going into effect next year is how small businesses buy health insurance. Today, if you're a group of less than 50 employees, your health insurance is priced based on 6 factors. The age of your employees, the gender mix of your employees, where you're located, who they cover, themselves, their spouse, their family. And then it also includes a risk consideration, plus or minus 25%. And then finally, what industry you're in, up to 10%. Well, beginning next year, you only have 3 of those left. The age of your employees, where you're located, and who they're covering. No gender, no risk, no industry. So when you take into account, and one of the things we've done within our association is looked at that because they're also putting a premium cap on the lowest and the highest premiums. So today, a young male rate is about 1/5 of the cost of an older male rate. And so why are young men less expensive than younger women? We can cause pregnancy, we can't have the baby. Right? But why are older men more expensive than older women?
Because you don't take care of yourself.
Because we're stupid. And so, about 50, the wheels start falling off, it feels like. And so, when you eliminate that gender disparity and you put those rate caps, what's going to happen is rates are not going to do this. Rates are going to do this. And so the younger folks are going to wind up paying more. And interestingly, 2 specific demographic groups are going to be most affected by this change. Younger men are going to pay more for health insurance than they do today. So are older women. And so when you take that into account, it is going to cause a change in the cost of how small businesses buy health insurance. Now the good news on the other side of that is, today if you're a small business, your health insurance rates usually change for 3 reasons. One of those is demographic changes within your group. Today the way small businesses buy health insurance in North Carolina, your rates go up every time you have an employee whose age hits a 5 or a 0. So, I've had some 10 and 15 life groups who had 3 people who hit a 5 or a 0, and that was about a 12% increase in their health insurance rates that year. I turned 45 tomorrow. And literally that would mean my rates would go up, not like I went from being 44 to being 45, but like I went from being 42 to 48. Well, one of the things that's changing out of this is we're getting an age curve that's not going to have steps. It's going to be more of a smooth pattern. So every year your rates will go up a little bit based on those age changes, but that's it.
Right, so right now you're going to have one age group that's 0 to 20. That's going to be one rate band. Anybody who falls in that section is going to have the same rate. And the same with 64 and above. Those are all going to have the same rate. But those ages in between are all going to be single-year rate bands. So a 24-year-old is going to have theirs, a 25-year-old is going to have theirs, and there's not going to be a differentiator between the sex anymore, male and female. It's going to be one rate for that particular age group.
And so that's one of the reasons your health insurance rates go up. The second reason is risk changes. You're a really healthy group, and all of a sudden 3 people get diagnosed with something. Well, your health insurance rates go up to 15% in North Carolina. And if you're at the upper end of that, you could really get hammered. And so, but becoming in 2015, that's off the table because there aren't any risk consideration at all. So the only real reason why rates will go up beginning in 2015 is because of trend changes. And the feds have already said, the states have already said, they're going to have to look really closely at every carrier's trend increases. Something that went into effect about 1.5 years ago was a requirement that any time a carrier wanted to increase their trend factor by more than 10%, it had to be reviewed. We already know at least 3/4 that at least one carrier got told they couldn't increase their rates that much. What was interesting to us is, for 10 years,
we saw trend increases for every one of our groups of over 10% until the fourth quarter of 2011 when we went this into effect. Now, I'm sure that was a complete accident, that all of a sudden it went to 9.4%. But what we're seeing is maybe this will also moderate the increases that occur year over year. Just skip that one. So, employer mandate, that's the thing most people are most concerned about. And so the employer mandate is very specific. Now, what doesn't it do? It doesn't require you to cover part-time employees. That means any of your employees who work less than 30 hours a week are not required to be covered on your plan. Also, if you're a small employer, meaning that your full-time equivalent count, and I'll tell you what that means in a second, is below 50, there's no mandate. So if you have 15 employees today, there's no requirement that you offer health insurance to your employees. Doesn't mean you're not going to, but it means it's not there. Interestingly, this is an older survey. A survey came out about 3 weeks ago that said 50% of small employers believe the mandate applies to them. It doesn't. It's only 50 FTEs or greater.
What if you have several locations?
They are.
Yes.
And so, what's the mandate? There's actually 3 mandates. The mandate is pay or play. You offer health insurance to your employees or you pay a penalty. The second part of that is the quality of the benefit has to be at a certain level or you pay a penalty.
And the last one is a limit on the contribution amount by the employee. And it's based on the single rate that the employee pays, your lowest plan, and it's based on 9.5% of their W-2 income is your safe harbor provision.
One of them.
One of the 3.
Yeah. And if you don't do that, you pay a penalty. So you see kind of the theme going here. So one of the things, what do you have to think about if you're an employer? One of them is how many full-time equivalents do you have? So hour worked is going to be part of that. You're going to look at common ownership considerations. And finally, who works 30 more hours a week? So I get this question all the time. Are there exceptions? No, there are not. In fact, I had an argument with somebody yesterday who said Congress and the federal government was exempt from this. They're not. It applies to everybody. For-profit, non-profit, governmental agencies out of county up in the western part of the state who all of a sudden realize that about 50 employees they've never covered on health insurance, they've got to start covering. And so those are the kinds of things that when we look at this are really being taken into account. So the 2 sets of numbers that you need to think about are full-time equivalents and full-time employees. And regrettably, they both have FTE in it, so it really gets confusing. Trying to find somebody to come up with some better shortcut for me. But each of these things are going to be important because it's going to affect different things. First question is, what's an hour? An hour is not somebody who's working, meaning that they're sitting, they're working in the warehouse, they're sitting in front of their computer, they're messing around, whatever. It means an hour that you pay them, whether they're at work or they're on vacation, sick, disability, whatever.
Right, so make sure you're taking into account all those PTO hours that are out there for the part-time. David said it includes vacation, holiday, illness, layoffs, jury duty, anything that's going to come into play as under your PTO qualification is also going to come into play when you're counting that person for number of hours worked.
So the first question is, how many employees do you have? So every one of your employees who works 30 more hours a week is a 1. Okay? Every one of your employees who works less than 30 hours a week is a fraction of 1, where the number of hours they work on average is on top, and the 30 is on the bottom. So it's not 40, it's 30. And so, work 25 hours, they're 0.83333, and it keeps going on. And so you're going to really then, at the end of the day, you're going to count all your 1s and your fractions of 1. And if you're over 50, you have to do this.
Right. You do get to round down, though, on that last employee.
If you're more than 50, then the mandates apply. Now, if you're only over 50 for less than 4 months, you're okay for that year.
So if you have over 50 employees, you don't have to do this form?
Not really.
Okay.
So what we've basically said is look at your schedule and, let's say you've got, how many employees y'all have total? makeup?
Total?
Mhm. About 85 employees. About how many of them work the same number of hours every week? Okay, so 75 or 80 work the same number of hours every week. Every one of them who work 30 more hours a week are a 1. Every one of those 75 or 70 who work less than 30 hours a week are a fraction of 1. And then you have this third category of what are called variable hour employees, whose hours change every week. Now, we'll talk about that more in just a second, but there's 2 other questions that have popped up. Seasonal employees. Seasonal employees, as a general rule, will not count. Now, when I say general rule, what I mean is, okay, usually they don't count. Okay? So what's a seasonal employee? Somebody who works less than 120 days a year at a pace, bless you. And then you see this definition here about it's seasonal work. So, I'm from Banner Elk. You know, we had a lot of ski resorts up there. We actually had a good year this year. Well, Ski Beach is open from about the first weekend in December until this year about the last weekend in March. That's less than 120 days. They're good to go. Most of those people who work at Ski Beach on the ski resort side will not count towards Ski Beach's number. Now, I had a bar owner in Boone who argued to me that he had a season. It started about August. It ended about May. And that was his season. And I said, well, that's a good argument. Good luck with that. Because that 120-day rule is going to be pretty hard and fast. And this has been one of those areas that as we go out and talk to our clients, we're really looking at this situation pretty delicately. I got a lot of farmers who, you got people who come and work for you for a while during the planting season, and they go north, and on the way south they're back up for the harvest time. Well, they're seasonal employees. But, I had 2 different camping situations the last couple of weeks. One involved a camp in the western part of the state where they have a summer camp season and a fall camp season. And sometimes they have people who work over both of those pieces. They got a little break between them. And my argument, I think, is a reasonable argument, is they have 2 distinct seasons there. Their summer season is about, kids staying overnight for a week. And then their fall season is predominantly 3 or 4 days of campers, and they're predominantly adults and kids. And so they have 2 distinct periods of time and 2 distinct different groups, so they're going to be able to do that argument. We also, the Baptist State Convention North Carolina is one of our clients, and they got all kinds of things all over the state. Caraway down in Asheboro has stuff that runs year-round. Now for them, the seasonal definitions are going to be a little more difficult. But it's going to be one of those areas that, we're going to look at it and say, yeah, they're going to be concerned about it, not only because they count towards your 50, well, they know they're 50, but it also matters because they could also be eligible for benefits. And so you've got to look at that piece. The second thing is independent contractors. Now, independent contractors are this thing that a lot of people have done in the past and said, that person's an independent contractor. Here's your 1099. You're an independent contractor. The IRS, the Department of Labor, and the workers' comp carriers have gotten pretty excited on this issue, meaning not really excited, really kind of worked up, because a lot of people are calling someone an independent contractor who's not really an independent contractor. And so we've kind of advised our clients, if you issue more than 5 1099s in a year to individuals, you probably want to take a look at it. Because if the job's more than, here's a project, have it done by the 15th of May, see you later, you've really got to look at it. I know people who call a 1099 somebody who's supposed to be in the office by 8:30 and out by 5:30, and they're in an office that the company's given them, on a computer that the company's given them, and they're probably not an independent contractor. So we really advise people to look really carefully at this issue. The IRS has, of course, very simple 11-point test to figure out whether or not they're really an independent contractor. That we're kind of helping our clients. So I'm going to give if you don't mind, I'll pick on you a little bit longer because you spoke up, so it's good for me. So, in your situation, 80 employees, but 75 of them really fall into one of these two categories. You know they work consistently a number of hours every week. You really don't have to worry about what you do with them, really counting them all the time. But those 5 you got to kind of worry about. And so what they created was this thing called a variable hour employee process. Now this is my simple way of explaining it. And I say that about as sarcastically as I can. It literally took me probably 20 articles reading this to kind of get it. So what you got to do with those 5 people is that you'll have a measurement period. It can be any period of time from 3 months long, 12 months long. And what you'll do for those variable hour people is you'll count how many hours they work every week during that measurement period. And then at the end of it, so let's say your measurement period is 4 months long. Okay? So for 4 months, you can literally just count it. A lot of payroll, a lot of accounting systems, I know like QuickBooks has already got kind of a report built to do this.
Right, most of your payroll companies out there have also built in some sort of accounting mechanism into it.
To start counting. So you do that for 4 months, how many hours they work every week, and then you have, at the end of that 4 months, an administrative period where you do the counting. But during this, you also have to notify anybody who works 30 more hours a week, who's a variable hour person, that they're now eligible for coverage, and get them enrolled. And then they're enrolled for what's called a stability period, which is at least 6 months long, or as long as your measurement period. So if you think about this being 4 months long, this being 2 months long, then this is 6 months long. And they're covered for that entire stability period, even if they start working 5 hours a week 2 weeks into it. So they're still covered, they still got to pay, but they're covered for that entire 6 months. But here's the hard part. This thing's like the dripping sink in the hotel room that you can't figure. It just keeps going.
Right.
So after the first 4 months is over, the next 4 months starts. And the next 4 months. And the next 4 months. And so this is one of those areas that we're really closely looking at each of our clients' individual situations. Because for some, a 12-month measurement period might make sense. Now, a 12-month measurement period also means you've got a 12-month stability period. And so it literally is almost a facts and circumstances kind of deal.
Once you set it, can you change it?
Yeah, but you've got to have a good reason for changing it. You can't do 4 and then 6 and then 4.
Right.
You know.
But the thing you can do is you can define a different measurement period for a different grouping of people. So if, let's say, you want to make, you run a nursing home situation, so you want to make all your PRNs one timeline. Maybe you're going to measure them for 12 months. But I'm going to make my RNs a different timeline, and I'm going to make my kitchen staff a different set of parameters. So you can classify out however you want to do that. The other thing to keep in mind is that, does your next slide go into
The new?
yeah, what happens when you hire a new guy?
Yeah.
Okay. When you hire somebody new, as David said, you're defining your initial measurement period, your initial administrative period, and then your initial stability period. Well, what happens when you bring somebody on during the middle of the year? Well, the law says you need to set up an initial period for them that is subject to just when they started. Now, you can back it to the first of the month or move it up to the first of the month to make it a little easier to calculate if you hired them on the 3rd or the 5th or whatever it is. But you run their initial measurement period based on the category you're putting them into, and then you have your administrative period, and then you have your stability period for them, and then you turn around and back them into the closest standard measurement period that you've already defined for that class of people. Did it thoroughly confuse you guys?
Which is why part of my solution to that problem is, if someone starts working in the middle of a measurement period, their initial measurement period is from that point to the end of the first measurement period. And so if they only work, 8 weeks in a 16-week period, then I'm going to count they worked so many hours over 8 weeks, and that's their average for that measurement period. Because she's right that they've given you a lot of flexibility, and my only problem with flexibility is complexity. And so it literally has become, here's the thing, and I'll say this about legacies as much as what we're doing for our clients. Anybody who tells you this is the right way to do it without talking to you, it's like they're not listening to you. I mean, we're really finding right now the best thing to do is to sit down with the client and say, tell me everything you do. Now let's talk about the best way to approach this, because what works for you ain't going to work for you. And it probably ain't going to work for you. And so we've got to really sit down and think about those situations on a one-by-one basis. Because I got people that we compete with who say, well, this is what all my clients are doing. All right, well, you know, all my friends in high school were jumping off the bridge too. So, you know, I'm trying to avoid that piece problem too.
Are they eligible for COBRA after
After the stability period, yes. And that's when their COBRA eligibility period starts. We kind of hoped this was going to take care of COBRA. We lost that argument so far. But
What about temporary employees?
are they your employees, or are they really somebody else's employees?
We were hoping they'd be somebody else.
If they're somebody else's employees, then that's fine. They're their problem. But, or if they're your employees, then you know, that's one of those situations that I think literally it's a matter of sitting down, because I got a guy out in Nashville who's in the same situation. He issued 2,000 W-2s last year and has as much as 500 people working at a time. Covers 30, got 300 out of those 2,000 that worked enough hours and worked long enough to where they probably going to have to offer them benefits. What you can't do is set up a separate company that is actually yours that your temporary people work for. So, you know, just,
Well, and I need.
yeah. See, I'm getting business for you already. We'll talk about the commission later on. So how's this work? So pretty straightforward. 30 employees work 30 more hours a week. You got 40 employees who work on average 20 hours a week. So now you got 5 employees who are variable hour, and during a measurement period, 2 of them worked over 30 hours. So for that period, what you got is the 30 are 30, the 40 are 26.6667, and then that variable hour, you got 2 that are over 30, and those other 3 worked about 25 hours, so together they're 2.5, you're over 61. So yes, you have to offer coverage. But this is where the second part of this comes in. You only have to offer coverage to those people who work on a full-time basis, meaning they work 30 more hours a week. So you really only have to offer coverage to these 30 and those 2. Make sense? If you shake your head, you really probably weren't paying attention. So it's one of those things where I said FTE is important, but so is full-time employees. And we got clients today who their FTE count is going to be over 50, but who they offer coverage to is below 50. Now, one other thing I take into account is called ownership, which is if you own multiple businesses. Because one of the brilliant ideas starting with this thing was, well, you know, I got 200 employees. So come 1/1 of 14, I'm going to have 5 companies, and every one I'm going to employ 40 people. So I'm below 50, I'm good. Wrong. So if you own multiple companies, they're all getting counted as one. And there are all these rules that fall under Internal Revenue Code 414C that really talk about what you own and why. It's one of the reasons why in the past, people in our business have never really said what else you own. Because we're kind of nervous if we ask, it's like we're trying to get more business, right? But now we're asking the question because it really could affect things. We have a client in Statesville last week we saw who a year ago, 40 employees, they owned the business, that's all they had, they were good. Earlier this year they took on an investor. Well, now he owns 40% of their company. Well, that guy's got another business that has 195 employees and also owns a hotel and a movie theater, and I don't know what else he owns. We're trying to figure that out now. Well, now all of a sudden that little company of 40 has to worry about this investor who's come in and his degree of ownership and how all that plays together. And so, the situation is like this where, and people who are accountants, who are my accountants in the room? All right, good. There's a lot. Usually there's like at least one person who volunteers, and then there's always you who's like, please don't pick on me. But, you know, physicians are the worst people in the world to ask what they own because they don't know. But, you know, we've got situations out there where somebody owns 3 businesses. One of them's got 20 employees, one 40, one 5. Well, today they offer benefits to this group and this group. But they've never in a million years thought about offering it to the 5 employees in that third group. Why not have to worry about it? Well, now all of a sudden, together they're over 50. And they got to do something for these 5 people.
Right. It doesn't mean you have to bring them under the same set of benefits.
Right.
It just means that for penalty purposes, now all 3 of those companies qualify. So if you are offering benefits to the 20 group and to the 40 group, that 5 group is going to be subject to that. I am not offering coverage, but I'm a large employer. I'm going to get nailed for $2,000 per employee divided by 12.
Yeah. So, now who do you have to offer coverage to? You have to offer to anybody who works 30 more hours a week. Again, with all respect, I don't care that you think 40 is full-time. The federal government said 30 plus hours, so that's what the rule is. Okay? So you have to offer to anybody who works 30 more hours a week.
But let me clarify one thing. That rule applies to medical coverage only. It doesn't apply to the rest of your benefits. So if you want to offer disability to only those working 40 hours or life insurance to only those working over 35 hours, that's completely up to you. The law is only pertaining to the health care coverage.
Right. Good point.
Do you have separate dental?
If you have
Same.
separate dental, same
Same
thing.
thing.
Whatever you choose to be full-time is full-time.
You also have to offer it to any eligible dependents under the age of 26. It doesn't mean you have to pay for it. You just have to offer it, so if they want to add their kids to it, they can. Interestingly, they came out and said you're not required to offer it to the spouse of the employee. Now, my working theory is that the person who wrote this rule is going through the ugliest divorce of all time. And so, they're not, and I've got a couple of groups who do this today because they had a lot of spousal claims one year. But that was one of the things that came out. So, one other thing that we're telling people is that there's a company called Zane Benefits that went out and told people, what you ought to do is give every one of your employees $200 and go tell them to buy their own coverage. And that, you know, they go buy their own coverage, you're done, no big deal. The IRS came out and said you can't do that. It doesn't count as coverage. It doesn't, you know, violates a benefit rule. It's going to be a ERISA violation. You just can't do it. There are still people out here talking about this solution, and they're probably former snake oil salesmen too. So just be very careful of this idea because they've already indicated they're really going to go after these situations. So what's the penalty for not offering coverage? If you don't offer coverage, the penalty is $2,000 times full-time employees. Here's my example. 75 FTEs, they got to offer coverage. But they only have 40 full-time employees. So the penalty is 40 minus 30. It's always 30. You've got 100 employees, it's minus 30. You've got 10,000 employees, it's minus 30.
Right. That was some senator who asked for something that they got the minus 30
And so it's
in the bill.
the great confusing thing out there. So in this situation, 40 minus 30 is 10 times 2,000. Their annual penalty is $20,000 for not offering coverage. Now this penalty is an excise tax, which means you have to pay for it with after-tax dollars. So if you think about that, all of a sudden that $2,000 penalty is more like about $2,700.
Well, then the thing I read from HHS said about $3,400 to pay for it.
$3,400. I like that number.
$3,400 profits to pay for a $2,000 penalty that's non-deductible.
And so be aware of that because it's one of those twists that they didn't really talk about. Because a lot of people, you pay a penalty, fine, just take it off the taxes, and no big deal. You can't do that. So that creates a problem. The other thing is, if you're taxed as a partnership, that penalty goes and allocates out based on your relative ownership of the entity. So you got 3 partners and your penalty is $20,000. Each one of you is writing the check for $6,600 and $67 whatever. So, you know, you got to write that check. And literally, that's been an interesting thing. I talked to a guy down in Athens, Georgia, who's talking about 100, had about 100 employees, and offers it to 20 today. And he did not want to write the federal government a $90,000 check. That was literally his whole mentality. So, second consideration is an unaffordable thing. And Terry mentioned the 9.5%. The way the rule originally was written, it said if your employees pay more than 9.5% of their household income for coverage, you have to pay a penalty.
Right, but employees aren't going to have any clue as to what your household income is. They don't know what your spouse makes. They don't know if you're
They don't want to know,
making
ideally.
investments.
Right.
Right. So what the HHS did is they came out and they said there's 3 safe harbors for you out there. The first one is the W-2 safe harbor, where you look back at your W-2 and say, is the price that my employee is paying for their individual coverage, doesn't count family coverage at all, it's just the individual coverage, is that more than 9.5%? If it is, they're golden. If it's under, they're subject to the penalties. Then you've got 2 other safe harbors. One is for minimum income under the federal poverty level, and the last one is the hourly rate one.
So, I mean, here's my example. I got this actual group of mine who, today they have their employees pay $148.30 per month for coverage, for employee-only coverage. And their employee, their lowest paid employee makes $9.50 an hour. Okay? So, the first test, it's box 1 income. Well, this person, their gross income is $19,750. But box 1 income takes out pre-tax. So they're paying $1,785 a year for health insurance. So their box 1 income is actually $17,975. Well, 9.5% of $17,975 is $142.30. And that's less than $148.30 a month. So they failed the first test. So the second test is how much they make in an hour times 130 hours a month. Well, that's much less than this. 1235, 9.5% of that number is 117.32. Fail that test too. Third test, as Terry said, is the federal poverty level. And the short answer is, if your employees are paying more than $88.43 a month for employee-only coverage, you're always going to fail that test. Good news is, you only have to pass 1. So what we actually said to this client was, any employee who works for you who makes less than $12 an hour, they pay $140 a month for employee-only coverage. And any employee who works for you who makes $12 or more a month, $12 or more an hour, then they'll pay $152 a month for the cost of coverage.
Right. The government says you can discriminate in favor of the lowly coverage. You just can't discriminate in favor of the highly coverage. So you can give more to that low-income employee, make them pay a little less per month, and make your more wealthy employees pay a little bit more.
And therefore we pass the test. And so again, now what's the penalty for not having coverage? $3,000 per employee who's over 9.5%. So in my example, 5 employees spend more than 9.5%, their penalty is $15,000. But there's a cap on that. And so let's say there have been 7 people. Well, the most this group's going to have to pay for not offering coverage is $20,000. So if they had 7 people, they'd pay $20,000, not $21,000. So only the accountants actually understood that piece. So that's great.
Right, but the other thing to keep in mind with this particular penalty is to be subject to the penalties as an employer. This employee has to not only not have coverage that is affordable, but they also have to go to the exchange, they have to apply for coverage in the exchange, qualify for a subsidy, and then take the coverage. If that employee never goes to the exchange and gets coverage with the subsidy, you're never subject to that penalty.
You're never going to call. Final question is, are your benefits at an adequate level? I mean, they have to reach a certain threshold. Now, if you're over 50 employees, it just means it has to be at the 60% threshold. And one of the things that we've actually done, they've given us a little calculator to figure this out. And so, literally, this is a group of ours, $3,500 deductible plan, $500 ER copay, $35 office visit copay for primary care, $70 for specialty. They have a 10, 25, 40 drug card. Okay? Their actuarial value was 62.8. They passed. In fact, to date, I haven't had a group who failed this without having to at least do one thing, and that is the most that this box, their out-of-pocket max box, can be is $6,500. So I got some groups of mine who, when you take into account deductible plus co-insurance, they're at $8,500. So you know what we did? We put in place a health reimbursement arrangement and said, every one of your employees who has a co-insurance expense above this threshold will reimburse you. Because not very many people will hit that number, and it solves your problem. So this is one of those areas that we're really finding that people's perceptions of failing this test and the realities of it are totally different. And so we're going to close with kind of one conversation, which is a lot of employers are saying, what are we going to do? So a lot of them are saying, we're going to drop coverage. Some people are saying, we're going to drop coverage. Pay the penalty, be done with it. And a lot of those people actually aren't going to drop coverage. They never offer coverage to begin with. Some of them are going to say, hey, I cover some but not others. I'm just going to pay the penalty. You know, I got a whole bunch of people who say, I'm going to manage my employee count so that my employees never work more than 30 hours a week. I had a restaurant owner tell me that the first time in July last year. He actually said he'd shoot the first manager who let somebody work more than 30 hours a week. I actually knew the guy, and I think he probably would have shot somebody. So, you know, that's kind of an indirect, not a recommended form of enforcement of your regulations, but that's fine. Some say they're going to drop it and subsidize. The problem with that is going to be that your employees don't get the subsidy, and you're kind of double paying there. So what do most employers say they're going to do? Most are going to cover their employees. In fact, today I'd say 95% of our clients who have 50 or more employees are going to keep offering coverage to their employees. Why? Partially because of recruitment and retention. You know, I've been in this business long enough that I know most of you are like a lot of other people in that you have three classes of employees. One of them are those employees who are really critical to what you do. You lose them, it's going to take you 12 months to replace them. I mean, basically y'all, you know. If you left, it's going to take 12 months to really replace that person. That's
There, it's there.
Give me that. Worth my child. I'll let Mary Catherine drive you around. I have a 16-year-old daughter now who's driving.
Yeah, I know, right?
Then you got a class of your employees. So if they left, it'd probably take you less than 3 months to get somebody back into that job who was doing it just as good as that person. And then you got a class of employees who, if you legally could run them off into a ditch at least 3 times a week, you probably would. And y'all all have those employees, and y'all know exactly who they are. The problem is, if you stop offering coverage, who do you lose? You lose those first group. And because they're all going to go somewhere and, you know, they're going to offer me coverage. I had a guy say, I'm going to pay all my employees about $300 or more a month to help them go get their own coverage, and it's going to be income, and they'll pay taxes, but that's how I do it. I said, that's a great idea. Surveys say, on average, an employer remembers they got a pay raise for about 6 months. And they'll go somewhere else and get paid the exact same thing and get benefits. And so a lot of people are saying, how do we make this work? And that's really been a lot of our work. So I could talk about this for much longer than y'all really want to listen to it. But Terry and I think, have seen a lot of things in the last 3 years. And I think right now we're really consistently saying to employers is, now's the time to talk about it. One of the things that we're really doing actively with a lot of our clients, you know, I've probably personally talked to somewhere close to 10,000 employers in the last 3 years about this. But now that stage is saying, all right, really, what do you have to do? And really sitting down and saying, here's your issue. Here's your issue. And I think the more you're talking to consultants who are doing that, the more likely you are to be able to really know what your game plan is. Well, some people don't have to worry about this until they renew in 2014, and that's great. I'm one of those people who, I think if you wait to take care of this, something's going to happen. And what we found consistently is a lot of the issues that we pop up and identify are things we can take care of now, so that then, come 14, my objective for 90% of my clients is for 2014 to be just like any other year. So other things to worry about, this won't be one of them. And I think that's really the mentality that we're finding is really important going into 14. Work now, get it done, not worry about it. So, be glad to answer any of the questions y'all have. We'll stick around for a little bit longer. I think y'all are going to do drawing, but Terry and I thank y'all for being here and for kind of mostly listening, so it's good.
Thank you, David, as well. Wow, that was a lot of information and a little scary. But he has provided this as a PDF, and I will go ahead and email that out to everyone so you have the benefit of maybe looking back through some of the stuff that he's presented. His contact information will be on that as well, and then we will also be loading the video on the website. So thank you all for coming. I want to thank Legacy Credit Union again for sponsoring our lunch today. We have done a business card drawing, and congratulations to Bill Johnson. You go see the ladies at the Legacy table. They have a fabulous gift for you. Woohoo! Congratulations. Anyway, help yourself to some of those materials. There's obviously some more food. Thank you for coming. Please give us your feedback, your ideas of what else you would like to learn about at our future luncheons. Have a great day. Thank you.